By and large, for most of the industry, I think most would like to forget 2024.
I want to talk about 2025, but I think it's also be healthy us to have a start to say, let's look back at 2024.
People underestimate how much they built through the shortage 3 years ago. So again, looking back before we go forward, I get the question a lot. Well, do you still stand by some of those numbers? And the answer is yes. Kind of in this environment where we get into 25, there's still more work to be done at the component level inventory.
Welcome to Leadership and Manufacturing Podcast. I'm your host, Sannah Vinding. I'm a strategic leader with over 20 years of experience in B2B marketing, product development, and team empowerment. In today's episode, we're going to explore more about the trends for 2025 for the electronics manufacturing industry. And I have invited Dennis Reed back, and I'm so excited because Dennis is a research analyst at Edgewater Research with over 15 years of experience in the financial services and also the technology sector. He's specialized in delivering insightful and actionable research on technology companies and on trends. So Dennis, welcome back.
Thank you for having me again, and Happy New Year.
Yeah, Happy New Year. So we are in 2025. I'm excited. So I want to talk about 2025, but I think it's also be healthy us to have a start to say, let's look back at 2024. So what's your takeaways when you look back for last year?
Sure. So I think, first of all, at a top level, by and large, for most of the industry, I think most would like to forget 2024. I think it was pretty disappointing by and large.
Yeah.
Inventory has been, and it's some of the cyclical drivers. Inventory has been stubbornly high. There has been a lot of work to reduce it. I think people underestimate how much they built through the shortage 3 years ago. So, you have that at a top down and kind of a year that everybody wanted to forget. And I think the other thing with that, and maybe I shouldn't say everybody, but I can't recall a time when you've seen such a bifurcation between one market being AI
Yeah.
and in the rest of the world. So, and what I mean by that is if you look, at the WSTS, and I'm going off memory, so the numbers won't be exact, but if they revised their forecast in early December, and I think it was something like a 16 or 17% growth for semiconductors this year.
Yeah.
Um, Inside of that, that included an 80% or 88% growth in the memory marketplace, one.
Yeah.
And then two, the rest of it was in logic vis-a-vis your largest AI processor company. So you look at that top-down number of 16%, and I know a number of people we engage with and work with in the industry, yeah, they were baffled, some of the executive teams, with, if you don't peel it back, of why aren't we seeing this type of growth in our business? And the reality was this, quote unquote recovery was not a recovery that in past you see a rising tide would raise all ships. It was a rising tide lifts your single biggest AI processor company to
Yeah.
a $4 trillion market valuation or something like that. And then it was the high bandwidth memory. And in that case, it was a huge ASP lift. So when you strip, those two areas out, you were in an environment that was probably down double digits last year versus a double digit increase overall. So, along with just being a year that kind of everybody wanted to forget, I don't recall a spread. There's always puts and takes. Memories obviously hyper cyclical, and we always look at it, the market with memory and without memory. But even with that, I don't recall, at least looking back in 10 years worth of data, I don't recall a more than 20% spread, if you will, or percentage point spread, I should say, between kind of the whole market and kind of that X memory world, ex-Nvidia world. So yeah, I think that bifurcation was very, very interesting as well. And while data, and I know when I've been on the past, we've talked about the use of data and some things like that.
Yeah.
I think what we've seen has forced a number of companies that don't necessarily participate purely in the AI to really look at how they use data, or maybe the story that goes around the data. Because if you're not levered to AI right now, that data is almost not applicable to you.
Yeah.
And you can't just fall back and say the market's X and we're that. So I think you've seen some kind of puts and takes around AI and in there too as well when you look back in the year.
Yeah. What about the whole EV? Because that's been a roller coaster by itself, right?
Yeah. So EV. I think when we met a couple of years ago at this stage, almost going on three, I had done a presentation in Austin at the ERA conference,
Yeah.
and ran out some very, very optimistic forecasts that talked about the potential of a 40 million unit market number, um, by 2040, or 40 million, I should say, is a part of the fleet, so an installed base, not 40 million annually.
Yeah.
Um, and the world drastically different than 3 years ago. But in some cases, I get the question a lot. Well, do you still stand by some of those numbers? And the answer is yes, but the geographic makeup and concentration is different than what we thought. So what has transpired in the East, in China in particular, with companies like BYD and NIO, is nothing short of amazing.
Yeah.
Uh, Now there's some inherent challenges in the Chinese EV marketplace right now. There's like 175 domestic Chinese OEMs, EV OEMs. There's no way the market can sustain 175 OEMs. So there will be a shakeout. So if you're a supplier, you kind of serve the market and you hope to win in all of them, because the risk of not participating or trying just to pick the winners or losers is far greater than seeing some shakeout. So I think there will be some shakeout, with kind of the OEM matrix makeup there. But in
Yeah.
general, what's transpired in the East is nothing short of remarkable. And the growth curve still remembers the West. Is a different picture. So, when you look backwards on the 2024 recap, at this time last year, 20 to 30% of all programs in the West were either delayed and or canceled
Yeah.
uh, for EVs. I think most of the fallout from that probably could be bucketed into 2024. So I don't think it's a huge headwind necessarily like it was last year. But it's definitely not going to be a tailwind as well in term, or as much of a tailwind, I should say, as it was in the past. I think the big challenge in the West, and I did say this to one of the questions at the ERA conference, in the West, I feel like somebody had said who's going to win or something to that effect. And I said, we'll never be able to mandate our way to success, right? And I think
Yeah.
that's what we were trying. And I think you'll see with several of the Western OEMs, there wasn't a viable product roadmap strategy that moved from internal combustion to a hybrid to an electric. It was, we're just going to jump that hybrid
Yeah.
and we're going to have success. And so the reality is, you caught when the whole automotive industry was on allocation, which we were in the shortage. If it was an internal combustion engine, you only had your premium feature sets being built top dollar above MSRP, et cetera. Well, if you were looking at that and the price was comparable for an EV, maybe you took a flyer on the EV. So you had your early adoption curve. And I don't want to make a ton of necessarily generalizations on the consumer, but I think it's safe to say that we've gotten past that kind of early adoption curve, and to get into an environment where 50% of the sales, let's say in the US, end up being EVs, the use case will have to look exactly like an internal combustion engine at a similar price point.
Price point, yeah.
Meaning, if you think about the user experience with the internal combustion engine, you get 3 to 350 miles per tank. It does not matter the weather, it still performs. And if you do run low, there's a gas station on almost every corner, and you can fill up in 5 minutes. So to me, if you want to see this environment where 50% of your sales in a year are EVs, you're probably going to need performance which is either in line with the internal combustion in terms of the battery.
Yeah.
One. Two, you need the charging structure in line with gas stations, which I haven't updated the data, but last time I did was a few years ago. There were 100,000 gas stations that have, I don't know, 8 to 12 pumps. So do the math. Versus 25,000 total charging, like not charging stations, like individual, wildly spread out. And if you do charge, even with a Tesla that's run down and you do like the supercharge, that's still a 25-30 minute wait.
Yeah.
So like that user experience is not the same. So you're either going to need to find the user experiences that's the exact same at the same price point, not a premium for the internal combustion engine, or you need to have lower battery, lower charge, etc. And you're going to need to drive the price point down below that of the internal combustion engine to drive widespread adoption. So that's why I think the top down, the good news is while you've seen a downshift in EV, the consumer has shown a preference for the hybrid. So you did see a nice uptick in hybrid. So if you look back downstream, it was a tough year in 24 for auto.
Yeah.
It was a relatively kind of stable year for overall auto in the US. You had to cycle through some puts and takes with inventory coming out of the shortage, but we're kind of in this environment where we get into 25. There's still more work to be done at the component level inventory.
Yeah.
But, I think over time, we get that work done. Automotive kind of works with a stable SAR or overall demand. You get a kicker from content with hybrids outgrowing the mix of internal combustion. You even have stability or growth in EV, just albeit not at 20, 30, 40, 50%, type growth in a year. And if you're a component vendor, like that all still kind of works where you can grow your business, call it 8-9% in a given year.
Yeah.
Once the inventory again, and that cyclical stuff's kind of worked through, like that's kind of the environment that we're moving back to. I think gone are the days of 25, 30% growth in automotives if you're a component vendor, just because you're not getting 40% unit contribution from EV. So a lot of puts and takes there. Like I said, to sum it up though, for this year, I would call it maybe net neutral, if you will, in terms of like the headwind tailwind, where last year there was a clear headwind with the projects being canceled that's funneled through to production and everything else. I think the bulk of that was felt last year. And right now we're kind of neutral where you've got a tailwind with just electrification, you've got a tailwind with hybrid. So we're closer to being on the other side. And then we just got to work through the inventory.
Yeah. So like decluttering last year, right? And now,
Yeah, 100%.
let's go for it. So what about other trends for now? We are talking a little bit about 2025. What else are happening? I know we have to talk about tariffs, right?
Yeah.
What else?
Yeah. So, tariffs, tariffs have been an interesting, and I think tariffs will somewhat kind of align, if you will, with the cyclicality that we're experiencing, or the down market. So it was, you look back a little bit to 2024, was at Electronica. Between my colleague and I, we had 50 plus meetings. You assume each of those had, 20 meetings, let's just call it, and a random number. That's between our meetings and call it that first derivative. That's like 1,000 plus meetings, right?
Yeah.
And so the timing of Electronica, the election was whatever, the first Tuesday in November. There was going to be an administration change, so it was like the number one question on everyone's mind is, what does the election result mean for tariffs? And I think it's, again, looking back before we go forward, it's important to level set. When you think about it, the tariff from China on the first of the year went from 25 to 50%. That was not the new administration. That was the previous administration. I would rhetorically, back in November, ask everybody, can you tell me the number of companies that were on the entity list when President Biden came into office? And they didn't know, and I don't know the exact number either. But then I would follow up with, well, are there more, less, or the same? And obviously there's more. So, I think in aggregate, when you look backwards over the last 8 years, whether it was, Trump's first term or President Biden's term, the relations with China have been challenging. So as we move into a new administration, I don't see much of a change in terms of this kind of tit for tat, trying to use your economic might, whether it's Beijing versus Washington or Brussels or you name it.
Yeah.
There has been, this willingness to use tariffs and other economic measures to try to force some level of diplomacy or lack thereof over both administrations. So I don't think that's great for business. Near term tactically, towards the end of last year, I know a number of suppliers were working very aggressively with distribution, trying to get product or take shipments in possession, move it out of China to avoid the tariff. And the general mindset is we're just going to line item on it. And the answer right now is no. First of all, we're over inventoried. And second of all, we're just going to line item the tariff increase on the first and pass it through to the customer. So that's kind of where we've been, where we go. And I would say collectively, whether it's, either side of the aisle in Washington, at some point, I don't think this climate of continued escalation between Beijing, Washington, and the European Union is good for anybody. So if between those three kind of governing bodies, if you will, if we could finally get an adult in the room, or three adults, one from each, that would probably hugely helpful.
Yeah.
I don't know if we're quite there yet. We try not to speculate too much on foreign policy and things like that. It's not our expertise.
No.
But I think over time what you see is we've been able to navigate it. It's yet to be seen the impact on inflation. It's yet to be seen the overall broader economic impact, but it's on everybody's mind. And then you're kind of wrestling with that, with the cyclicality and the fact that you're over inventoried, profits are under pressure, right? All of those stuff that just kind of come with the puts and takes in and out of an up and down market.
Yeah.
And, right now everyone's kind of frozen. I would venture to guess, again, when you compare the previous administration versus the current, I think the biggest difference has been, call it the the communication via social media. And I'm not saying one's right or wrong. So I think, one of the administrations has obviously been much more vocal with the use of tariffs via social media than the other. So I think the big difference you see in the next 4 years is maybe it's a little bit more vocal via social media, non kind of quote unquote official channels.
Yeah.
But again, I don't see a significant change in the policy. And I think it's something that collectively the governments need to figure out. We're not going to decouple from China. Like that is not the US and China cannot decouple, I believe, in an overly simplistic way.
Yeah.
That's successful for both. So I think they're going to have to find a way to exist in work.
Yeah. It's like a new balance, right?
Yeah.
That needs to occur. What about let's talk about growth. I would love to talk about growth, right? We want we want to see that. So is there any specific segment or industries you look at now that you can see this is where you believe, I know we're just predicting, right?
Yeah.
But what you believe is saying that could be some potential growth for 2025.
Yes, I think, I'll hit on the easy one, is, that AI, that dichotomy between AI, memory, and the rest of the world, that's going to continue
Yeah.
this year. So, um, that's the easy one to say, which, depending on who's listening, that may or may not impact them. I think if we strip the AI world out, it's a much more kind of nuanced picture. So, I think when you look at any market, and I touched on auto a little bit earlier, so I'll kind of level set, kind of what the top-down view is for automotive. So if you've got a flattish kind of end demand SAR environment in the West,
Yeah.
you've got, you don't have the same headwinds in EV. You have kind of the hybrid kicker and then general electrification. That again sets you up for kind of a high single digit kind of growth for just automotive components over time.
Yeah.
Industrial markets, you could run through the same thing, whether it's robotics, automation, electrification, semi-cap equipment. All of those things are kind of unchanged as a top-down driver. So that's again another, call it mid to high, so call it 6 to 8% grower. Medical, you've got two segments of medical. You've got call it CapEx driven, like radiation machines, things like that. And then you've got, more dispensable, disposable, right? I'm thinking like RFID tags with like syringes, things like that, right? The disposables continued mid-single digit, grower, and then you kind of ebb and flow over time. So again, you're in a 5-6% growing market for medical. And then you've got aerospace and defense, which, the world is whatever the world is between the issues in the Middle East, the issues in Europe. But with all of that, you could look at any defense contractor and the backlogs are in the hundreds of billions of dollars. You have a nice tailwind. You probably don't get the 20+% grower. So as you can see, kind of top-down demand is fine over time. When you look at just 2025 in kind of the vacuum for this year, we're still working through inventory, and that's the cyclicality of it.
Yeah.
And I think, the level set scenarios, we've probably got 6 months left to go with that. But so to us, the real question is, when you think of that as your base case, is there more risk to the upside or downside in that scenario for just this year? And I would say there's probably more risk to the upside. And I'll run through, a couple of reasons why. One is just the down market is long in the tooth, right?
Yeah.
So we had 36 months in an up, so 3 years in an up cycle, give or take. By the middle of this year, we'll be at 2.5 years. You're starting to fall within historical norms. It should turn. That's kind of your lack of analytical rigor, kind of why it should be better.
Yeah.
But what's really starting to happen in very, very isolated cases, it's close. It's important now to watch, the drawdown, if you will, between what is lead time and what is cycle time for any component. So there has been so much finished goods, and not in everything. And again, we're seeing just minor cases of this in individual suppliers, individual markets, but there have been so much inventory that was created. You're at this, and you've operated in an environment where literally your lead time is how fast you could drop ship it from anywhere in the world.
Yeah.
And you can have it, effectively in 2 days anywhere, to your cycle time is normally 16 to 20 weeks. So yes, suppliers have cut back utilizations across every end product type, but yes, they built die bank, things like that, to shorten that cycle time when orders rebound, but that's never a perfect science, right? So you have this environment, and like I said, we've seen isolated cases at the end of the year where an order comes in, I'll make up a number, of $5 million of part number ABC123, and that $5 million order is like a 20-week lead time.
Yeah.
You could get 2 million of it tomorrow, but the remaining 3 has to go through the full cycle. So, you're starting to see very, very isolated pockets where that's happening, which gives us more confidence that, again, it's hard to change your overall view with the year just because it's isolated. We've had a couple of head fakes, but there's a little bit more concrete that, again, if we're wrong this year on kind of that second half, call it second half, mid-single digit, first half,
Yeah.
Low single digit declines, gives you kind of low to mid single digit growth this year, call it, 1 to 3%. If it proves to be better than that, it'll be more supply driven. And I would say the other part of that is, there was significant capacity brought online in the upcycle. And
Yeah.
this goes back to a little bit of the tariff and some of the geopolitical tension. A lot of that capacity has also been added in non-traditional geographic locations, whether it's Vietnam, whether it was India, Malaysia, Thailand, Mexico. You can go through the list. So when you would have to start ramping, you're also going to be ramping capacity in locations where you have it could just, it's not impossible, it could just take longer, right? So I
Yeah.
think you could get into the, out of the first quarter. I think the real checkpoint will be when we exit the Lunar New Year. In particular, call it February 1 for a roundabout date. That'll be, where's inventory sit?
Yeah.
What does that mean? What does that mean from an order book, backlog, lead time? But yeah, I think we're moving closer to, you could see a little bit more of like a cyclical, quote unquote, snapback this year than, where we were. If we would have said at this time last year, our thought process for all of last year was 24 is a wash. This year, there's a little bit more hope on the cyclical side, even though the long-term demand drivers haven't changed.
Yeah. Yeah. And it's always right when you say, what is going to happen. Because I remember if we look back for last year, everyone's like, oh, just need to get over the first quarter, right?
Yeah.
Then the second, then the third.
Yeah.
And then it's like, we're done.
Oh, no, 100%. At this time last year, even if you go back, 4Q22, well, we just got to get through the first quarter. And then the
Yeah.
answer, the question we would ask is, so what's your cycle time? 16 weeks.
Yeah.
Do you have any bookings for the second quarter? No. Well, why do you think the second quarter is going to recover?
Yeah.
Two things have changed, as I mentioned. One, it's that cycle time versus lead time equation's a lot closer to being out of whack.
Yeah.
and two is just kind of the geographic breakdown of the capacity that's added is different. So the labor ramp will be a little, we believe will at least be a little bit more challenging in potential the cost of disruption.
Yeah. No, it's good. 2025 is the year, right? I hope it will be. No. So, but I want to hear, now I will touch a little bit on 2024, 2025, but I want to know, what excites you for what's going to happen for 2025?
Yeah, I think, and I'll be a little selfish with this answer. What's the best for our business is when the market turns, right? Because then you can hopefully demonstrate your value by being early and right.
Yeah.
Whether that's our financial customers or our industry customers, it's the ability to predict the change. And so when, I would say the same thing 3 years ago, when you're at the tail end of an upcycle, there's only so many reports and interviews and webinars and et cetera that you can do that just says, well, lead times are out, prices are going up, people are for 6 years. It's the same now. Like there is no lead time, there is no demand, there is no booking. So, from our business standpoint, I do genuinely want to. It doesn't persuade our approach, but I genuinely would like to see a change, and hopefully we can time it and get it right. So that's one. I think, two, it's going to be very interesting. This is kind of a big picture one. We've talked a little bit about, the growth in AI, the growth in memory. That has been really more so than anything else. It's been an ASP/mix recovery in those two markets. I think we're a little bit unprecedented in terms of the magnitude of that growth. So it's going to be very, very interesting. And again, I think AI is real, and it's not to say that it's not, but just to see that market actually move in actual business use cases really being developed and monetized will be very, very, very interesting to watch and exciting to see. Who are the new companies? Because I would venture to guess, yes, there will be your major CSPs and people like that that'll be front and center with it, but there will be an entire crux of multi-billion-dollar companies that are probably in early stage, like venture financing right now, that will be multi-billion-dollar enterprises in the next several years, and it's hard for me to imagine, what they can do. I think, when you think of the use case right now, whether it's a chatbot or it's not overly revolutionary. You read some of the futurists and things like that, and I still haven't seen anything concrete that drives a subscription. So, or monetization maybe is a better way. So I think it's going to be very fascinating to see the industry move from building data centers to monetizing this, and what type of opportunities that could create for the overall supply chain. Because it's easy. I mean, I won't say it's easy, but we know how to build data centers, but making money off of those data centers, which is what's needed from like a long-term sustainability of the business model, that hasn't been developed. And we're talking about, $100 billion plus a year industry that effectively 2 years ago barely existed is pretty remarkable.
It is. Yeah. Yeah. No, I think it's exciting, right, to see what's happening. And I think with the AI, you really need to keep an eye on what's happening.
100%.
Because it is moving so fast. So don't fall behind it.
Yeah, no, 100%.
Okay, Dennis, I love this. I think it was great to do reflecting on last year and then just the beginning of this year, right? Even though it's just a prediction and saying this is what could happen, it's always good to hear, what you see and also what you know. So thank you so much for sharing it at today's episodes.
Thank you very much. It's always great to be with you.
Thank you for joining us for another episode of Leadership in Manufacturing podcast. I love that you're listening. Please find us on YouTube and wherever you get your podcast, and be sure to subscribe and rate us. Also, follow our LinkedIn page and Instagram, and check out leadershipinmanufacturing.com for previous episodes, blog posts, and our newsletter. So let's continue this journey together to become better leaders in the electronics industry. Remember, stay curious, keep learning. See you next time.